Today, we're talking about bonus depreciation in 2026 and how it connects with cost segregation for real estate investors. This is one of the most impactful tax provisions you can use to accelerate deductions and improve cash flow. Let's begin with a quick recap. Bonus depreciation allows you to deduct a large percentage of the cost of qualifying property in the first year it's placed in service, instead of spreading that depreciation over many years. That means you reduce taxable income early when tax deductions are most valuable. For decades, bonus depreciation has been an important tool for investors and businesses. It was part of the Tax Cuts and Jobs Act of 2017, which allowed 100% bonus depreciation on qualifying assets placed in service between 2018 and 2022. Under the law as originally written, bonus depreciation was scheduled to phase down from 100% to lower percentages, 80% in 2023, 60% in 2024, 40% in 2025, 20% in 2026, 0% in 2027. This created a shrinking window where full bonus depreciation would be available. But then Congress passed the One Big Beautiful Bill Act, which was signed into law in July 2025. One of the most significant changes in that bill was to restore 100% bonus depreciation for qualifying property placed in service after January 19, 2025. And importantly, this 100% bonus depreciation is now permanent, not subject to future phase-outs. So what does this mean for 2026 and beyond? For property acquired and placed in service after January 19, 2025, qualifying assets remain eligible for 100% first-year deduction under bonus depreciation. That applies even if those assets are placed in service in 2026, 2027, or later, as long as the acquisition and placement dates meet the statutory requirements. It's important to understand what qualifies. Bonus depreciation applies only to qualified property, generally tangible property, with a recovery period of 20 years or less. These include items like appliances, carpeting, furniture, certain lighting, security systems, and land improvements such as sidewalks, parking areas, and landscaping. The building structure itself, including walls, roof, and foundation, still depreciates over 27.5 or 39 years under the standard modified accelerated cost recovery system. That portion does not qualify for bonus depreciation. That's where cost segregation becomes valuable. A cost segregation study is a detailed engineering-based analysis that identifies which components of your building qualify for shorter lives. By reclassifying those components into 5, 7, or 15-year categories, cost segregation increases the portion of your property that becomes eligible for bonus depreciation. With 100% bonus depreciation restored permanently, every dollar you reclassify through cost segregation can potentially be written off immediately, instead of over decades. This turbocharges your deductions and can create substantial first-year tax savings and improved cash flow. Here's a simple example. Imagine you buy a rental property for $1 million, excluding land. A cost segregation study might find that $300,000 of that cost relates to shorter-lived assets. With bonus depreciation, you could fully deduct that $300,000 in the first year. The remaining $700,000 continues to depreciate on the normal schedule. Without bonus, that $300,000 would still depreciate faster than the building structure, but over 5 or 7 years, not all at once. That timing difference can make a huge impact. Lower taxable income in the first year means you pay less tax today. More cash stays in your business. You can reinvest, pay down debt, make improvements, or pursue more investments. Now, there are 2 practical points every investor needs to know. First, to qualify for 100% bonus depreciation, both acquisition and placement dates matter. Only property acquired and placed in service after January 19, 2025 qualifies for the full 100% bonus. Second, Even though bonus depreciation is permanent under current law, you can still elect out of it if you choose. Some investors prefer to spread deductions over time for strategic income planning. In 2026 and beyond, you now have certainty that this powerful deduction won't vanish. That lowers planning risk and lets you build long-term tax strategies around bonus depreciation and cost segregation together. If you want to know how bonus depreciation could impact your property, the best place to start is with a cost segregation analysis tailored to your situation. Visit costsegregationguys.com to request a free, personalized proposal. They'll help you model the depreciation impact, estimate potential first-year deductions, and show how cost segregation and bonus depreciation work together to improve cash flow and long-term returns. Don't leave valuable deductions on the table.